I am increasingly viewing the high yield market in the States, the building products part of it, as essentially it is a leverage play on the US housing cycle, disguised as effectively a diversified kind of quasi-industrial index. And the next phase of stress, I would say, probably looks less like classic bankruptcies and more like a wave of LMEs, drop-downs, exchanges, and maturity wall engineering. In other words, for a lot of the Lightside names, the biggest risk is in capital structure design, not in whether housing starts get to 1.3 million or 1.5 million.
Welcome to another episode of Fixed and Floating. Today we are talking building materials, a sector where stress is showing up at both ends of the Atlantic at the same time. In the US, we have 4 high-yield names which are actively distressed. And in Germany, a wood panels manufacturer named Pfleiderer has executed a drop-down deal, moving his adhesives business outside the restricted group. And yet at the same time, QXO has agreed a $17 billion takeover of TopBuild. So we have Lightside distress and Lightside premium happening simultaneously. Is it a cyclical trough or a longer cycle? To entangle that, I'm joined by Andy Belton, head of basic materials at CreditSights, and one of the few analysts who cover building materials in both the US and Europe. Andy, welcome to the show.
Thank you very much, Joseph. It's a pleasure to be here.
Andy, before we dive in, give the audience a quick 30-second on what you cover at CreditSights and how long you've been doing it.
Sure thing. My primary responsibilities at CreditSights are to be the senior analyst for building materials and high yield construction. I've been at CreditSights for some 20 years and I've covered building materials throughout that time, and as well as high yield construction. I also had 10 years on the seller side at Citigroup prior to that, and even way back in the midst of time, I was at Fitch Ratings. And throughout that time, I've covered building materials. So I've been lucky or unlucky enough, depending on your point of view, to see the last 3 to 4 business cycles in this space.
Building materials can be separated between, we're talking Heavyside and Lightside. Could you walk us at the beginning through that distinction, not as a product taxonomy, but more as a credit framework? What makes a cement plant structurally a better credit than a window factory?
Certainly, yes. I think the credit markets generally see cement plants as structurally stronger than windows factories, just to using your 2 examples. And that's primarily because cement has a much more defensible business model through the cycle. Essentially, cement is a highly local product. It's expensive to transport. Each plant tends to serve a very limited regional market, which often creates a local oligopoly and really only a few viable competitors. And that basically supports more rational pricing trends for your products, steadier market shares, and of course, more durable margins. In contrast, window manufacturing, just again to use the extreme example, is usually much more fragmented. It's competition from local producers, distributors, from the import and export market, and of course from substitute products. And that means that pricing power is much weaker. So that's the first point. The second point is barriers to entry in cement manufacturing are extremely high. Building a modern cement plant can cost anything between hundreds of millions of dollars right up to more than $1 billion or euros. And of course, it requires permitting, access to quarries, environmental approvals, logistics, and energy infrastructure. Whereas a windows factory can be set up much more cheaply and quickly, so new entrants can usually appear much more quickly and therefore target and pressure margins for the incumbents in windows much more than they can in cement. I think the third element I would say is cement plants are often viewed as strategic infrastructure assets. Cement, of course, is essential for housing and public infrastructure, which in turn can provide a degree of support from lenders and refinancing access. And now in distress, cement assets typically tend to hold their value much better because quarries, permits and kilns are very scarce resources and are expensive to replace. In contrast, windows factories usually have weaker recovery value for bondholders because the machinery tends to be more generic, and of course facilities are often leased. Now, the cement businesses also benefit from a degree of vertical integration. They have stronger capacity discipline and more stable cash flow characteristics through the cycle. While cement, of course, is carbon intensive, regulation can actually strengthen incumbents by making entry from new operators even harder. So overall, in credit terms, we see the cement plant as a scarce, capital-intensive, locally protected asset with a durable pricing power and stronger recovery value, whereas a window factory is really seen as much more competitive and less defensive from a business perspective.
You just listed a couple of very important points which should increase margins for the heavy side. You cited regulatory points. You also cited local points. We are talking here a margin difference of 6 percentage points, a much lower leverage for the heavy side producers, and we are talking also a much higher free cash flow conversion held over multiple cycles. I think you mentioned before that you have witnessed 3 to 4 cycles. Where does this durable advantage come into play?
Sure. Essentially, it's a pricing mechanism. And it comes from, I talked about that cement, concrete and aggregates are very much more local markets. And the benefit of being a local market is you have great pricing strength. Now, added onto that, you've also got typically for cement companies who are selling to construction contractors, you have quite a dissolute client base in terms of the contractors. The contractors typically are local, quite small companies, whereas what is increasingly happening in cement is you have concentration at the national and the global level. And what that means is you essentially have, as the supplier of the cement, you have a greater degree of pricing power. And that's very different to the light side, partly because of the differences in the number of products on the light side. So in the heavy side, you're typically talking about cement, concrete, and aggregate, so 3 pretty essential products. On the light side, you can be talking up to 10,000 separate SKUs, and that really undermines your ability to be a price maker relative to the cement companies. And just to give you an example, over a 20-year period encompassing the last 2, I would say, construction and macro cycles, Heavyside building materials have demonstrated pretty much materially superior through the cycle pricing transmission versus the light side. To give an example, cement prices have compounded at round about 4 to 5% annually, compared to on average between 1 and 3% for lumber, using lumber as a very good example of the light side. And obviously that reflects the fundamentally more defensive market structure of the local heavy side materials compared to the light side.
Another key element is that despite the light side having much more SKUs, is that it's much more PE owned, right? And what
Correct.
You've also seen is that we now have much more challenged capital structures. So is this general a characteristic of the light side industry, that it's much more dispersed? And is this also a structural disadvantage for the light side industry? Or is it really about the kind of owner that ends up there?
I think the honest answer, Joseph, is a combination of the two. Now, as I've talked about already, heavyside building materials, whether it be cement, aggregates, asphalt, or ready mix, they do have these structurally stronger credit characteristics than the light side. And when I say light side, I'm talking about everything from windows, doors, cabinets, flooring, and of course, interior products. And I've mentioned before, but some of the main reasons underlying this credit strength is higher barriers to entry, freight protected local markets, obviously a scarce and very difficult to permit assets on the aggregate side, this stronger pricing durability, and of course the much greater exposure to the more stable infrastructure and public construction end markets. Now, these characteristics typically support more stable cash flow through the business cycle and lower earnings volatility, and that in itself tends to allow for a structurally advantaged position relative to the light side. But we can't ignore ownership, of course. Private equity ownership is by nature far more common in the light side, partly because the light side businesses are easier to purchase, they're easier to consolidate, they're operationally easier to improve and to leverage from a financial and a operating perspective. And as a result, light side credits typically carry much higher degrees of leverage. They have more aggressive financial policies, and of course, they are much more exposed to construction cycles in the resi market as opposed to the infra and parts of the non-res. And I think this can exaggerate what is clearly an actual difference in credit quality between the two sectors. So I would say even after adjusting for ownership structure, the heavy side businesses just retain, I would say, structural advantages because fundamentally the underlying industry economics, they're better.
There's a recent research by McKinsey which is saying that the intra-segment return on invested capital spread exceeds inter-segment. So the execution beats exposure. Your framework is much more exposure-led. So where do you actually disagree with McKinsey?
I think it's more in semantics than in fundamental. And I think part of the difference is also explained by what the equity market looks at versus what the debt market looks at. Now, McKinsey is correct that ROIC dispersion within the subsectors in building materials is clearly greater than that distinction between the heavy side and the light side. But from my perspective, that observation is much more of a relevant one for the equity market than it is for bond investors. Now, as a reminder, equity markets focus primarily on the upside potential, operational execution, and creation of value. In contrast, credit investors really focus much more on the downside protection, the cash flow resilience, and the survivability through multiple economic cycles. And this distinction essentially makes the structure of the industry much more important in credit analysis than it does in equity analysis. Heavyside businesses like cement benefit, as I mentioned before, from a number of strong industry characteristics like high barriers to entry, greater exposure to infra, etc. And even average heavyside companies can actually retain more strategic relevance and more asset value during downturns. And in contrast, many light side building materials companies are much more exposed to the cyclicality of residential, competition from imports, and of course pressure from their retailer customers. And obviously the situation is often amplified by the impact of PE ownership and high leverage. So overall, while execution does tend to dominate exposure for equity investors, credit investors are much more focused on sector exposure and structural resilience. In simple terms, equity investors focus on the ceiling, whilst credit investors focus on the floor.
If you are getting value from fixed and floating, there's even more waiting for you on Substack. We publish written analysis, deep dives, and extra content you won't find anywhere else. Head to fixedfloating.substack.com, subscribe for free, and come take a look. And now, back to the show. In the BAML High Yield Index, we have a lot of building material names, but it's mostly residential and it's mostly light side names. So is the high yield building products trade essentially one big trade? So let's say along the US housing cycle, but just dressed up at 10 different tickers?
I think the honest answer, Joseph, is yes. I think from my perspective, I am increasingly viewing the high yield market in the States, or the building products part of it, as essentially it is a leverage play on the US housing cycle, disguised as effectively a diversified kind of quasi-industrial index. Now, the companies, of course, all sell very different products: windows, cabinets, roofing, flooring, siding. Fundamentally, they're all exposed to the same macro drivers: housing starts, mortgage rates, affordability, repair and remodeling spending, and even dealer inventories. Now, in good markets, investors tend to focus on company-specific execution and operational improvements. But during downturns, the correlations tend to rise sharply, and the whole sector often trades together as kind of like a leveraged housing beta, particularly because issuers, are private equity owned, and again, similar leverage structures and refi risks. Now, it doesn't mean, of course, that all of the light side companies are identical, but at the index level, the degree of diversification is actually often much weaker than you might think at first glance, and particularly when housing markets are under stress.
At the same time, we did see one large transaction, right? So QXO has agreed to a $17 billion takeover of TopBuild, right? So we have seen a sophisticated player which was very successful in rolling up various industries in the past. And he paid a premium for a Lightside installation business, right? As we have seen a couple of other high yield names also in the Lightside industry are in active distress. Does that deal disprove your Heavyside beats Lightside framework or refines it?
I think it's possibly what I would call the exception that proves the rule. I think what it does prove, if you need good assets, and scale does help to offset some of the risks of private equity ownership and some of the structural business risks that I talked about. There's no doubt that scale would help. I think if you think back to when I was talking about some of the operational differences between the heavy side and the light side, one of the big things is pricing. Now, it's a tenet of essential macroeconomics. I studied when I did my university degree way back when, that economies of scale are ever present, and economies of scale are real. And they really can help to a degree to counter some of those structural business differences that I talked about. It doesn't mean that my thesis is not valid, but what it does mean is that the only way to kind of beat the market, or beat the house, if you like, is to have real scale. And with real scale, you get scale economies in pricing, scale economies in your purchasing, in logistics, in everything. So it's one of those things that can help you to offset the risks, but it's not available to an awful lot of players. And typically, as you know, getting private equity to sort of to consolidate a sector into a significant degree is quite challenging, because very often private equity sponsors would have very short-term windows. And I think in order to build the kind of scale of the TopBuild, you really need either to have the initial scale at the outset, or you need to have a kind of progressive roll-up strategy, and that takes time.
Yeah, and the thing as well, as I would say, is that it's sometimes very tough to really roll up a very fragmented market, and usually the pricing advantage only accretes in very localized and specialized markets, which you don't always have. If we go from the resi side more to the non-resi drivers, so ACA has US real construction, I think, now to -3% in 2026 after -4% in 2025. Could you put that numbers into context? I think you have a couple of more numbers, and just to give us a handle on what that means for the heavy, but also for the light side.
Sure. I think the most important number for me is the residential decline. We've talked consistently about the difference between the heavy side and the light side in structural terms, but in end use profile, infrastructure tends to be much more stable over the business cycle, and residential, of course, is early cycle and is much more volatile over a long period of time. So for me, the residential number is possibly the most eye-catching. Home building materials credits are the most weakly positioned, so any consistent and continued decline in real construction spending is much more of an issue for them, particularly as that ability to control price is much weaker than it is on the heavy side. Now, the number that I would say that is not so much wrong as maybe slightly misleading is the public construction number. The public construction is set to decline by about 3% this year. I think actually the most recent spring forecast from the ACA has trimmed that slightly. But the decline in real construction spending on the public or the infrastructure side is as much coming from building materials inflation as it is from weak nominal numbers. And of course, we've got to remember that when it comes to dealing with the suppliers themselves, that materials inflation is actually helping the stronger investment grade credits on the heavy side, like a CRH or an AmRise. So those two numbers for me are sort of by contrast, they're the bookends of real construction spending according to the ACA. The number in the middle, of course, is in terms of importance or eye catching nature is non-residential. Now, the 10% decline in non-residential, in a way, is maybe more eye-catching, but actually, what it is a combination of factors, and a big part of that is just a natural cyclical runoff of the benefits that we saw during the Biden era from the Inflation Reduction Act and for the Chips and Science Act. To an extent, we had expected this kind of handbrake from manufacturing to come in from sort of 2024 onwards. So for me, the public / infrastructure and the residential numbers are possibly the more impactful.
Nominal building materials revenue has really exploded from 2019 to 2022. So especially during the housing boom. But if we strip pricing out, what does the volume picture really look like? Where are we versus pre-pandemic and at today's plant utilization? How much margin is at risk if volumes drop another 5%?
Look, you're right that the nominal number has been obviously massively has been massively overstating effectively the true health of the sector between 19 and 22. There absolutely was a genuine demand surge in 2020 and 2021 from housing, from the R&R markets, the repair and remodeling markets, and from the rebuilding of housing stock and inventory. But by 2022, volume momentum was already starting to fade. We saw the impact of mortgage rates rising. And of course, since then, many building products, Lightside building products categories have drifted back towards pre-pandemic volume levels. Even though when you look at revenues at the top line, they still look elevated because pricing is still well above the levels it was in 2019. And of course, that does create the credit issues that we've talked about, because a lot of the high yield light side issuers are still carrying effectively the heavy capital structures that were built up between peak 2021 and 2022 when EBITDA was at its highest point. And it's not necessarily that these earnings were inflated, but they were obviously at that point there was unusually strong operating leverage. There was good inventory dynamics in terms of the distribution channels, and pricing was very strong. Today, many plants on the light side are operating already below what you would say is the optimal rate of utilization. So this means that any kind of 5%, additional 5% decline in volumes is going to have quite a disproportionately large impact on profitability. Now, for many fixed cost manufacturing businesses like windows, cabinets, or flooring, a 5% volume decline could translate into anything between 10 and 20% EBITDA decline. And that could potentially put something like 100 to 300 basis points of EBITDA margin at risk. Obviously, that has quite a significant impact on leverage cap structures. So the real debate for credit investors is not whether revenues are above the levels we saw in 19. It's how much of that current EBITDA that we're seeing is generally structural versus how much of that was simply pandemic era pricing and the impact of operating leverage.
If we look at single family starts, we sit at 937K, I think, in 2025, projected another minus 2% in 2026, and then we are inflecting 2027. At the same time, we do see the median new home square foot is eroding for a decade. So we have smaller and smaller homes. I think USLBM has disclosed minus 4.5% average size between 2022 and 2025. Is the bigger threat the starts number or the dollars of content per start number?
I think, to be honest, Joseph, the bigger issue is the housing starts number. Content per start does tend to help growth and margins, but starts drive the physical volume that keeps your factory utilization high and it keeps your cash flow healthy. Now, a window or a cabinet, flooring, or even an insulation plant is built around units moving through the system. So, for example, if we see housing starts fall from 1.5 million to 1.1 million, all of a sudden you see factories losing throughput, fixed costs become an issue, your distributors start to destock, and EBITDA can unravel very quickly. And that's the real credit risk on the light side. By comparison, when you have higher content per start, bigger homes, more premium products, upgrades to energy efficiency, smarter home systems, this is all very supportive, but it usually cannot offset the impact of a major decline in unit volumes. And remember that in downturns, builders often simplify specifications and consumers are kind of forced to trade down in specs as well. So that's why credit investors like myself tend to focus much more on starts, permits, the level of inventories at dealers, and of course at utilization rates, rather than focusing on any sort of narrative of premiumization.
If you look at a specific home, so an average US home, I think that per home materials equal around the 150K. So split exteriors into 35K, framing is 40K, interiors 35K, mechanical 40K. Where does the entry-level mix shift hit hardest in your coverage? Windows, siding, cabinets, insulation, or doors?
I would say if you walk through the average home, the entry-level mix shift does not tend to impact every category equally. Now, the biggest pain would be in the discretionary, the more specification-heavier interior products. So, for example, cabinets, windows, doors, and sort of premium finishes overall. If we talk about cabinets first, builders, when they get affordability pressure, they can shrink the size of kitchens, they can remove kitchen islands, they can downgrade from semi-custom specifications to just those they have in stock. They can simplify bathroom settings. They can cut down the number of premium finishes. So, for example, a cabinet package can fall from between 20 and 25K to maybe 12 to 15K pretty quickly. And because cabinet manufacturers tend to have high fixed costs, complex factories, and also massive numbers of SKUs, EBITDA can collapse much faster than revenues. And that, I would say, is almost like the classic light side exposure. Windows are fairly similar. The house still needs windows, but you can, as a builder, you can shrink the opening sizes, you can eliminate architectural shapes, you can simplify the glazing process, you can downgrade the quality of the frames. There are lots of things that you can do. Windows profitability, of course, is heavily driven by specification complexity. So even if units volumes hold up pretty well, the premium mix can disappear quite quickly and your margins start to compress pretty sharply. And actually, interestingly, doors also tend to get harder than people might think. Entry systems, patio doors, interior finishes are all very easy areas for builders to suddenly say, do you know what, we're going to standardize and make them cheaper. So again, mix deterioration is much more impactful and worrying than it would be pure volume. Now, sidings tend to be a little bit more resilient because the house still needs that kind of exterior envelope. But again, builders can move from fiber cement, which is more expensive, to vinyl sidings, which are cheaper. They can remove stone veneers. They can simplify the trim packages. So there are many ways in which you can also see mixed pressure. But I would say sidings would see less mixed pressure than, say, cabinets or the more decorative types of interiors. Insulation, I would say, is the one the outlier rather, and it's reasonably defensive. It's very difficult to materially downgrade your insulation because of things like building codes, standards for energy efficiency, etc. So lower square footage only really modestly reduces your demand, and insulation actually is almost kind of a quasi Heavyside category rather than one of the more discretionary light sides. So that's really the dividing line, I would say.
And I guess a key theme here as well is that affordability issues on the housing side has also reduced demand for especially more expensive or more individualized items on the window, cabinet, or door side. If we look at the R&R side, so we went from 404 billion in 2019 to 611 billion in 2022. And then we see a very flat performance, flat to 0.8% by 2025. With around 300K in homeowner equity, 40-year median housing age, and mortgage rate locked in. What would you say would specifically unlock the next leg in renovations and repairs?
Interestingly, if you look at the fundamentals, you're right that for R&R, they do look pretty strong. You already mentioned, huge equity cushions, 40 years old as a medium US home size, or age, I should say. And because of the mortgage lock-in, people are tending to stay in their homes longer. That, in theory, should be very positive. So the problem is not balance sheets, though. It's psychology and financing costs. Now, I would say the R&R market is one of those incredibly confidence-sensitive sectors of building materials. Homeowners may have 300K of equity and a kitchen that needs replacing, but they still experience hesitation because they get a number of high contractor quotes, or financing starts to feel more expensive and economic confidence remains shaky. They get very nervous. And a lot of R&R activity is driven by confidence. And if any of these external factors are impacting your confidence, that is a real barrier. So people need to start feeling more comfortable to be able to spend again. Financing, of course, amplifies this. In that sense, HELOCs help because homeowners can borrow against the equity without giving up their low mortgage rates. But floating rate debt still does feel unattractive to, I would say, many consumers. The most important unlock, of course, may be actually fixed rate second lien mortgages. They do allow homeowners to preserve their ultra low first mortgages whilst also allowing financing reservations with a bit more payment certainty. That could become potentially an important product over the next R&R cycle if rates stabilize at a lower level than they currently are. We have to add on to that, of course, the impact of the general economic uncertainty and war in the Middle East and what that does in turn through higher oil prices. All of this tends to reduce consumer confidence and reduce the confidence of people when it comes to major R&R projects. So I would say the biggest unlock for that market is confidence. And at this stage, with the Middle Eastern war where it is, I'm not sure where that's coming from in the short term.
If you go from resi to non-resi, we are sitting now at, I think you said, minus 10% in 2026, heavily driven by manufacturing. But if we go through the sub-segments, let's say manufacturing, roll-off, then you have office, retail, and multifamily, commercial. Where is the real swing for Heavyside versus Lightside credits?
In terms of actually, interestingly, non-res, a lot of the Heavyside actually are more exposed to the non-residential as you might think. So we've talked a lot about the impact of the Inflation Reduction Act and the Chips and Science Act. And what the IRA in particular did is it had a lot of reshoring of industrial manufacturing capacity from overseas back into the US. And that was to the benefit of a number of the big Heavyside cement manufacturers. So companies like Cemex, CRH, and Amrise in the US have all been riding that trend, that positive trend for some time. So if we talk about a 10% fall off this year in non-res and a 5% decline next year, significant chunk of that is in manufacturing. The numbers we're talking about in manufacturing are minus 23% in 26 and minus 14% in 27. Now, a lot of that is kind of a revert to a mean. So to an extent, that's less of an issue for the Heavyside guys because they are still very heavily exposed to infrastructure and they also have a good degree of exposure to residential. So it's not a credit negative for the Heavyside guys in terms of the decline in manufacturing construction. And the other areas, office and retail, is obviously important, and I know that we're going to talk about that in the next segment. But one of the new blacks in terms of the non-residential sector is, of course, in data centers. But we'll talk about that, I guess, in the next section.
Then dive right in. You mentioned a data center is a big big growth sector for the whole US economy. I think it's adding more than 2 percentage point this year in growth. But I think what you mentioned before is that the actual impact on construction, it's much less than we would anticipate, given
Correct.
that a lot is concentrated in power, chips, and so on, much less in the construction side. Maybe you can add a bit more color around the themes here.
Yeah, sure. I mean, look, in nominal terms, there's no doubt that data center construction does continue at a massive rate. Obviously, it's fueled by this massively rising demand for cloud computing, AI, and obviously machine learning. We all are seeing that in our business in finance, of course. Just to give you some context, in January 2026, spending on data centers overtook traditional office spending for the first time ever. And that's according to the American Cement Association's spring forecast, which literally just hit the tape last week. And actually, data centers now accounts for just over 50% of office construction spending, and that's unprecedented. And as a result, the ACA has modestly revised upwards their expectations for data center growth in 2026. But, and it's important, but let's try and scale this appropriately. Data centers account for just 12% of total non-residential construction, and they're only less than 3% of total overall construction. So they're a great headline. They're a very useful source of premium pricing they're particularly for the Heavyside construction materials producers, but they are not game changing in terms of the directionality for non-residential. And they're also clearly not as important as infrastructure and public construction for the Heavyside. That's where, if you like, the real money is. And that's where the credit strength still remains.
Another key driver is usually highways and bridges, right? And I think over 50% of the funding in these sectors is still unobligated. How do you think about the construction side with regards to highways and bridges and infrastructure in this way?
Yeah, I think in your sort of question when we did the run through, you were talking about, in credit terms, are you kind of underwriting the runway or the cliff or just the gap between expiry and reauthorization? And honestly, Joseph, I would say it's quite hard to assess in the current political climate. Now, normally, I'd say credit investors are effectively just underwriting the gap between expiry and reauthorization. However, we have to recognize that US politics is currently the most polarized, well, in the 40 years that I've been involved in finance. We have midterms later this year with a realistic possibility of a Democratic-controlled House trying to apply a brake to an incumbent president, whilst the administration seems to be continuing to try to govern by executive order. Now, Trump's priorities in his second term have been very much focused on international trade, of course, and geopolitics. And to my mind, it doesn't seem likely that a new infrastructure bill is going to be top of his list of priorities. So I think the risk is whether the House manages to kind of fund infrastructure by continuing resolution until we have the next US presidential election in 2028, when it becomes that you bring the possibility of a coordinated House and executive branch, and that might be what's needed in order to generate some real traction in terms of the next infrastructure bill.
In terms of public construction itself, I think it's forecast minus 3% real in 2026, and that's the first retreat in years. I think you mentioned it, that especially under the Biden administration, we've seen a lot of growth there. At the same time, at the moment, we do see inflation rolling off. We do see real demand softening, or even both. Which Heavyside names will get hit the hardest if the latter applies?
I think it is more inflation driven rather than underlying demand driven, and I think the comment from Ward Nye, from Martin Marietta about the 50% overhang in highways funding does illustrate this. If you listen to the commentary from the Heavyside Aggregates credits, they are basically testament to how much demand is continuing to rise. Vulcan talked about a 3.5% rise in demand in its first quarter this year. Martin Marietta was at 13%. Now, we recognise that the first quarter is, because of weather, the least important through the season for these companies, but it is a very good signal sender on the underlying health of infrastructure. At the same time, pricing continues to remain on a very strong upwards trajectory. In the first quarter, Vulcan generated about, again, 3.5% rise in average product prices, whereas Martin was about flat. Both names are actually looking forward in 26 as saying 2% volume growth and somewhere between 3 to 4% on product pricing inflation. So we're going to see a continuation of this upwards trajectory. Now, if the reverse does happen and demand does actually start to drop and we see, God forbid, real demand destruction, then I would say the most exposed are obviously the likes of Vulcan and Martin. CRH is one of those interesting names. It is very big in infrastructure, but it is actually more diversified than those two peers, both from a end use perspective, but also from a geographical perspective. They still have about 25% of their of the EBITDA coming from Europe. So I would say CRH is within the Heavyside IG cohort. CRH is the strongest, and Vulcan and Martin, in the unlikely event that we do see a complete reversal in the current trend, then these two would be more exposed. But I have to say that would seem to be unlikely from what I'm seeing and what I'm hearing.
I think you give data centers measured weight versus the whole market. And how do you see the actual upside versus downside skew on Heavyside? And what would have to break for it to materially disappoint?
Look, I think it's data centers are an important growth driver, but it's not the most important issue for the Heavyside names. I think, as we've talked about in previously in this section, the overall cadence of public construction is still by far and away the biggest potential positive. And the biggest headwind remains the natural runoff, if you like, of industrial construction. So to be honest, I think data centers doesn't need to disappoint, and it wouldn't really be as big an issue as the headlines might suggest. I know it's very big in financial newspaper headlines and Bloomberg headlines, but for my guys, it is less of a risk on the downside, as well as being actually less of a fillip on the upside. So it's important, it's headline driven and headline grabbing, but I would say it's not a fundamental credit issue for me.
Just taking a quick pause here. If you're finding this breakdown useful so far, please forward the episode to a friend in credit or high yield who should probably hear this. Also double check that you are following Fixed and Floating so the next episode drops straight into your feed. Alright, let's get back into it. If we dive deeper into the stress, so we have 5 distressed building product situation at once in the US, 4 with Cornerstone, JELD-WEN, Oldcastle and USLBM, and then Pfleiderer and a couple more low names in Europe. Is it generally that we can speak about these as very idiosyncratic capital structure stories, or is it a reckoning of the PE era leverage?
I think the honest answer is it's a combination of the two. Don't forget, these are all individual stories, of course, but to my mind, the challenge of funding the Lightside through the kind of leverage cap structures that you typically see in private equity owned companies is definitely coming home to roost. Even in the IG end of the space, there are still more Heavyside names than there are Lightside, and the better rated and the stronger credits are definitely on the Heavyside. So I think there was always going to be, to some degree, if you like, a stress test of the PE structure in Lightside. There's a reason why, as we've talked about earlier, why PE structures are much more common on the Lightside rather than on the Heavyside, and you can only try and beat the macroeconomics for so long.
If you dive into one of the more specific names, JELD-WEN, I think that's the cleanest case for what's actually breaking the Lightside. Could you walk us through the business?
Yeah, sure. So doors are about almost 2/3 of the revenues for JELD-WEN. Windows are about 19%, and there's a sundry other. And interestingly, for what is primarily a North American business, they do have a quite an interesting little chunk of revenues coming from Europe. Now, as you expect, because they're doing doors and windows, essentially this is a residential new construction play. So it accounts for basically just under 50% of their revenues in terms of end use markets. 41% is R&R, which we've talked about before, and then a rump of about 13% is non-residential. Now, the big thing about JELD-WEN, as it is for a number of these credits on the light side, is there is a great deal of concentration in its customer base. Its top 10 customers generally account for about 50% of the revenue base, and the two biggest customers, Home Depot and Lowe's, account for 30% combined, Home Depot taking about 17%. Obviously, that's an enormous degree of concentration in terms of channels. And that does have an impact, as far as I'm concerned, on the business, both in terms of bargaining power, but also in terms of the ability to offset inflation in a downturn. Taking JELD-WEN as JELD-WEN's sort of example, large customers have a great deal of leverage on their pricing. So essentially, JELD-WEN is a price taker, not a price maker, like a Cemex or a CRH would be when they're selling cement. And that also means that the customers can also have quite a significant degree of leverage on things like standards of service required, and even on things like your shelf space. Now, in a downturn, that does mean that JELD is going to struggle to push through price increases or cover inflation because of the power of Home Depot and Lowe's. It also means that when you see any slips in service, you lose volumes a lot more quickly than you would do if you had a more dissolute customer base. And of course, you also see a degree of compression in your price cost spread, and that's exactly what's happened to JELD-WEN over the last few years.
87% of revenue is residential, so new construction plus R&R. They sit in the same channel cluster as Builders First Source and Master Brand. What would you say is the actual quarterly cadence on door volumes and SAPs? Are they more tracking single family starts, R&R discretionary, or both?
I would say it's both, but the bigger issue right now is volume, not price. The business, as we mentioned, is 87% resi. And at the moment, management is guiding down both new construction and R&R for the year end 2026. They're talking about low single-digit declines in single family and mid-single-digit declines in R&R construction. And in the first quarter 26, North American core revenue was about 14% lower, and that was driven in turn by 13% volume and a mix decline impact, and about minus 1% due to prices. So you can see it's very heavy, driven by volumes, not price. Now, the quarterly cadence essentially says that doors demand is tracking both housing and discretionary R&R weakness, and volume is doing most of the damage at the moment.
If you look at the individual securities, so equity is down around 49% year to date. The CFO has just left, and I think the term loans are at around 90, so on the senior secured level. Senior unsecured notes are in the 70s, have rebounded a bit alongside the equity. Could you walk us through what the difference is between, or the drivers are between the different parts of the cap stack? Is it just cycle driven, or is it governance driven, or is it just due to different assumptions on recovery within the cap stack, or a mix of everything?
As always in these things, Joseph, it tends to be a mix of everything, but recovery is a big issue, and it's being driven by collateral, your maturity position, and your optionality. Now, remember that the term loan sits higher in the cap stack. It has collateral support, and it benefits from flexibility in documentation, so it tends to trade higher and better. The unsecured notes are pricing the real refi risk around a December 27 maturity, and particularly because, of course, those bonds effectively go current in December of this year. And at the moment, it's increasingly looking like conventional refi might become difficult, with JELD-WEN carrying about 9 times leverage.
So on the geographical side, we have 33% Europe. That's pretty meaningful for a mostly North American perceived business. And especially as the drivers are, or like the negative drivers are mostly US. Does the European book offer any real offset, or is it just along for the ride?
I think it offers a little bit of diversification, but it's not a true offset. Europe, of course, at the moment is more stable than North America, a very unusual position as a long-standing building materials analyst, I have to say. And management does expect Europe to be broadly flat in 2026. And at the same time, we've also got core revenue was only down about 2% in Europe in the first quarter, compared to the much more steep declines that we saw in North America. But Europe is still weakening in terms of earnings and margins. And to be honest, if anything, it could be a potential disposal candidate as far as I'm concerned. This is just my own view. My special sits team in the States who are actively covering that name may have a different view, but I kind of think that the European business potentially, if you sell that, in a way you do give some optionality, you do give some degree of solving of the maturity issue. It still doesn't solve your operating problem, but it does give you a little bit more of a window. Whether or not that's actually possible, that's a different story. I think it's very hard to sell assets when you're a fire seller, particularly if you need the kind of multiples that will give you a meaningful chunk or meaningful support to your deleveraging push. So as far as we're concerned, we still think that the company's under quite significant pinch.
If you look at the margin side, I think OC just reported its stores business at around 7.2 EBITDA margin in the first quarter of 26, whereas the overall group's EBITDA margin level of 16.3. If those are around 2/3 of JELD-WEN, what's the steady state margin you'd underwrite, and what does that imply for the whole cap stack?
I would probably more say, sort of on a steady state basis, reasonably modest margin, taking into account their sort of weaker market position and their concentration of customers. I'm talking probably high single digits at best. Not the normal kind of building products mid-teens margin that you would try and target. Remember that the current reported margin is just under 4%, and even with some recovery, the business is still very heavily skewed towards lower margin doors rather than more value-added ones. So even if you assume something like between 7 and 9% through cycle margin on what is seemingly a lower structural revenue base, that supports a business that maybe can just about survive, but still leaves the capital structure very tight, given the fact that you've got this massive leverage overhang of 9 times.
All points towards the high risk of a potential liability management exercise. Could be probably more on the unsecured side of the bonds. Or how do you think about the potential risk of a broader restructuring?
I think right now the setup, to my perspective, tends to point more naturally to some kind of bond-focused liability management exercise. So LME first, rather than actually an immediate full restructuring. And I think that view would be shared by my special sits colleagues in the States. The loans are better protected by their position in the cap structure and, of course, a collateral package. And, of course, the unsecureds are the natural maturity pressure point. And effectively, they're already trading as if they are effectively the shock absorber in terms of any restructuring or any LME. If Europe doesn't get sold and North America doesn't stabilize, there is the possibility that could widen into a bigger restructuring exercise at some point. The pressure points are not going to change. And JELD-WEN, like most of the other peers, is still requiring some degree of turning of the cycle in order to relieve some of the natural pressure that your high leverage profile and your private equity structure tends to exert.
Building materials are also very prevalent in the leveraged loan market. And we've also established earlier that private equity is also very big in US building products. How does this change the credit analysis if you have a lot of loans and especially a lot of PE owners versus traditional high yield bond work where you have somebody listed with only bonds in the structure.
Yeah, of course. If it's a straightforward high yield bond, then it's relatively straightforward analysis. It tends to be fixed rate debt, longer maturities, more stable cap structures, and distress starts to show up through widening of spreads, and then through refi risk, and then through eventually, if things continue on the down cycle, then through default. The modern building products universe is very different now because so many issuers are private equity, as you mentioned, and therefore also tending to go through the lev loan market. So that means you're not just underwriting the operating risk, but you're underwriting an entire sponsor-driven capital structure with a great deal more flexibility and therefore far more risk of liability management. And the first major difference was in this cycle was interest rates. We've seen obviously the leveraged loan market has seen the stress first because loans are overwhelmingly floating rate. So as the Fed funds rate surged from 2022 onwards, interest expense repriced almost immediately, and therefore bond issuers with fixed coupons were a little bit better insulated. Then, unfortunately, you then saw windows, doors, and cabinet companies suddenly facing collapsing interest coverage even before maturities became a problem. So economically, the loan market has been the one that has felt the pain first. But of course, in a way, the loan market, because of the flexibility you have in covenants and LME, you kind of delay the recognition of formal distress, because a lot of leveraged loans are now covenant light. Issuers have enormous flexibility to avoid default through A&Es, through incremental debt drop downs, through up tiering transactions. So unlike as you might have seen in older cycles, and I've seen quite a few in my time, weaker companies haven't necessarily been restructuring really early. They've survived much longer because of aggressive liability management exercises. Doesn't necessarily help you if you're a bond investor or a leveraged loan trader, but it does mean that you delay that kind of that immediate pressure. So that's the second big change versus obviously traditional high yield credit analysis. In high yield, it typically does EBITDA recover. The real question now is whether creditors basically get structurally primed long time before default even happens. And in sponsor-owned building materials names, things like collateral, receivables and subsidiaries can often be moved around the cap structure in ways in which they materially weaken any recovery values for existing bondholders. CLO ownership, of course, has also been a driver of change market behaviour. And because lev loans largely sit heavily within CLOs, the market has become much more tolerant of extensions and amend and extend transactions rather than forcing restructurings, which has probably kept a number of weaker issuers alive a lot longer than if you had the kind of more traditional high yield bond market would have allowed.
In Europe, in building materials, we are quite a bit ahead of the US. So Pfleiderer already had the first restructuring, I think 2 years ago. And in December 25, they did another drop down with the movement of Silicol assets outside the restricted group. So could you walk us through what Pfleiderer did in Germany with Silicol? And is this the European parallel to the USLME activity?
Mm-hmm. They essentially sold 90% of the equity of Silicol to newly created unrestricted subs. And so effectively you're moving Silicol outside the restricted group that was, of course, a significant support for the bonds. Once it was outside that ring fence, those unrestricted entities then raised new debt. There was about 110 million that came from Mohawk and about 25 million that came from SVP, secured on the Silicol shares. And of course that matters because the new debt sits ahead of the existing bondholders, while Silicol's guarantee and collateral package for the notes falls away. Now, why is this a parallel to US LME? Because economically, it's essentially the same playbook that we've seen in the States with J.Crew style drop downs and other aggressive LME transactions. You move valuable assets beyond the reach of existing creditors, and then you lever up those assets separately to raise fresh funds and effectively prime your old debt holders. The modern twist here is that Pfleiderer appears to have used an asset sale structure to sidestep tighter post-restructuring investment limits and priming caps. So the key takeaway overall is even in Europe and even after covenant tightening, sponsors are showing that they can still extract collateral value through structural engineering rather than going through the more formal amendment process.
So I guess that's also a precursor of what's coming potentially in the US. And I think 3 of the 7 distressed names we kind of discussed already show explicit LME activity. If you look at the BCG DACH crisis radar, then also the restructuring sentiment is re-elevated in Germany. Would you say that the European single B Lightside sector is the next cluster of creditor-on-creditor violence, and which names are here most exposed?
I think, to be honest, yes, the Lightside single B cluster and interestingly, the PE-owned distributors, so the building materials distributors, are, I think, becoming potentially one of the clearest emerging pockets of LME and covenant aggression risk in European high yield credit. Now, the backdrop is very similar to what we saw in US: weak residential demand, higher rates, falling EBITDA cushions, ownership by sponsors, and a heavy maturity wall. In this case, it's 27 to 29. What's changed, of course, is that Europe was historically viewed as more consensual, tighter documents, less aggressive restructuring behaviour. But the Pfleiderer drop down and recent exchange activity does seem to indicate that sponsors are increasingly willing to do things like test portability, structurally senior debt, and to also test drop down mechanics, even in Europe. Now, the real risk cluster is not necessarily the really weak triple C names. It's in the kind of single B stressed cohort. So bonds trading between 60 and 85. There's still some enterprise value, but you've got a lot of refinancing, deterioration in refinancing visibility, and obviously partly because of events in the Middle East and macro uncertainty. And this is where sponsors, I would say, still have incentives to preserve equity optionality through things like exchange offers, super senior debt, or even drop downs. The distributor space may actually be even more exposed. These are effectively leveraged spread businesses that depend upon inventory turnover, supplier terms, and housing volumes, but without any of the kind of hard asset protection that you would typically get from a cement or an aggregates business. Many of these distributors sit within the Euro lev loan market, and they have covenant light docs, they have massive EBITDA add backs, and they have incremental debt flexibility. So I think if we do see a wider wave of covenant aggression, my own bet would be the PE-owned Lightside distributors, and to some degree the manufacturers, is probably where it becomes most visible. Just to give you an example of some of those names, there was a name that I used to cover called Start Group, which is a Nordic building materials distributor / builders merchant chain. It did actually have a high yield bond at one point, but then refinanced through the lev loan market. I actually think they're a good name, but they are an indicator of the fact that you've got a lot of lev loan activity in building materials distribution, and thereby you've got a lot of covenant risk. And I think that particular space is where I could potentially see some flexes coming in the future.
So is the LME wave more an expression of the sponsors losing faith in the cycle turning fast enough, or is it just an opportunistic exploitation of covenant flexibility while they still can kick the can down the road?
I think it's both, to be honest, Joseph. But the deeper signal is that I think sponsors no longer believe that the cycle could turn quickly enough to bail out these heavy cap structures in a sort of clean manner. Now, you got to remember that a lot of these Lightside building materials and distribution businesses were underwritten for what was expected to be a very quick post-COVID normalization. And instead, volumes have remained very weak. Rates have remained stubbornly high, not helped by war in Europe. R&R spending has softened, and leverage has never really come down. So now maturities are getting closer, while EBITDA recovery is actually taking a lot longer than expected. Now, that's not purely distress. At the moment, sponsors are behaving reasonably rationally, but also opportunistically. So if the covenants allow flexibility to do a drop down or an up tiering or an exchange offer or whatever it may be, and the loan market is still open enough to allow them to do that, then why would you write a big equity check today? So LMEs are kind of becoming almost like the preferred middle ground. It buys you time, it keeps your optionality, and you kind of hope that the cycle improves later. But for bond investors and for therefore my clients, the message is important. If sponsors genuinely believed housing snapped back so hard in the next 12 months, then many of these deals would actually be refied conventionally rather than through sort of LMEs. And the fact that the sponsors are reaching for more aggressive liability management tells you that they're planning on a slower for longer recovery.
If people or listeners want to do more of the homework themselves and not only rely on your research, if we go into the mechanics of operating leverage, which is key in building materials, what's the typical utilization profile for, let's say, a cement plant or a aggregates quarry, and where does fixed cost absorption start to bite? If we look at today's Heavyside utilization, is it still supportive or already stretched?
So the answer is the operating leverage on the Heavyside is basically a story about utilization and fixed cost absorption, as you already mentioned. Cement plants and aggregate quarries, remember, are hugely asset intensive. Once you build the kiln or you secure the quarry, much of your cost base doesn't really move. Your maintenance costs, your labor costs, environmental compliance, depreciation, all of that doesn't really move the needle in the same way as your capital costs do. So profitability depends heavily on how full your system is running. Now, for cement, the sweet spot I would say is between 80 to 90% capacity utilization. Once you get below about 75%, your fixed cost absorption starts to drop quite meaningfully. And below something like 70%, you can get really quick margin compression. And the reason for that is kilns have to stay hot. You still have to maintain the kilns, and the lower your run rate goes, the worse your energy efficiency goes. So operating leverage in cement is really powerful, not just on the way up, but also on the way down. In contrast, aggregates are slightly less extreme, but they are very similar in principle. Healthy utilization for an aggregates quarry would be typically anywhere between 70 and 85%. If quarry volumes start to fall too far, then road hauling, blasting programs, reserve development costs, they all get spread over much fewer tons, and therefore your unit costs start to rise really quickly. But here's the critical credit point, is that Heavyside investors are structurally more disciplined because the assets are so expensive and local. Nobody casually builds a new cement kiln, and what that does is it keeps supply pretty rational and it keeps pricing relatively resilient even in down cycles. So if you look at utilization rates, particularly in the US today, Heavyside coverage still looks very broadly supportive rather than being stretched. Resi demand, yes, it's softer, but infrastructure and data centers are still keeping plants reasonably at full rates. Now, most producers are no longer running at peak utilization, but they're not also sitting in any kind of danger territory of underabsorption. And that's a clear contrast with the Lightside. For example, as I've mentioned before, a cement producer, if he's doing 78% capacity utilization, he's still generating good cash flow because his pricing power holds. A windows or a cabinets factory running at 78% utilization looks much weaker because capacity is easier to add and your pricing is much less disciplined. So the Heavyside today feels more like a kind of a normalization from peak levels, whilst parts of the Lightside really feel like they're working through the post-boom overcapacity.
As you've already mentioned, the Lightside, in terms of, or if you're talking about windows, doors, panels, is the operating leverage cliff steeper or much shallower than Heavyside? And similarly with the fixed cost base, is that actually higher than it should be after a decade of consolidation?
Clearly, it is. You're right. It's steeper in Lightside than it is in Heavyside, but it's also, I would say, much more steep than investors would assume. Now, remember that a cement kiln and aggregates quarry has massive high fixed costs, but it also benefits from local oligopoly, high utilization rates, and some degree of variability in fixed cost. So that any margin erosion tends to happen reasonably gradually. In contrast, if you're making windows, doors, wood panels, cabinets, it's a very different process. They look asset light, but operationally, you're very rigid. You still have high labor overheads, you still have operating shift structures, you still have routing logistics, service networks, ERP systems, and even very heavy sales infrastructure. So once you see any decline in volumes, labor productivity and fixed cost absorption deteriorates very, very quickly. And for example, that's exactly what Cornerstone was calling out in the fourth quarter. Underutilized manufacturing and distribution infrastructure in the face of declining volumes. And interestingly, on the light side, consolidation may actually have worsened the problem. Over the last decade, you've seen roll-ups build national manufacturing footprints, branch networks, and corporate overhead structures that were really sized for the peaks of 21-22, rather than the kind of 1.2, 1.3 million housing starts we're seeing in the current world. And obviously with a cost base built for something much higher rate. So there's a real problem there.
So what you're saying is more than that you have on the light side more issues on the SG&A side, and potentially if you would have had more localized player, then probably you wouldn't have had this this growth in overhead in general. If you look at the M&A side in Heavyside, I think that shifted from a scale grab more to a reserve grab. So the permitting mode, does it really change how you underwrite VMC, MLM, or CRH in general?
No, I think you're right that the moat is increasingly just becoming the permit itself, but it doesn't actually change the fundamental nature of the business. Okay. If you look at Vulcan Materials and the Cal Portland divestiture, or CRH buying Weaver in Texas, these are basically reserve and market access deals in very constrained metro situations or metropolitan situations, and they're not just focusing on unlocking EBITDA. And it was the same with the Martin Marietta asset swap with Quikrete. It was all about optimizing their reserve positions and the pull through from the downstream angle, particularly in ready mix and asphalt. Now, the critical point is that capital does remain available, but permits are not. In a lot of US markets, getting a new quarry can take you up to between 10 and 15 years of entitlements, or it might simply never happen because of zoning or environmental opposition. So if you got the chance to add a already permitted quarry in Dallas or Phoenix or the Atlanta, all of a sudden it's behaving a lot more like an infrastructure asset rather than more of a cyclical commodity asset. And that's the reason why you end up with very heavy multiples for names like Vulcan, Martin, and CRH. What looks like an EBITDA EV multiple of 15 to 7 times is not really paying for current earnings. You're locking in 50 years of irreplaceable reserves, a local monopoly position, but also embedded pricing power. So you're really spending now to generate your future EBITDA.
If we zoom out from the micro to the macro, we do see Europe outpacing the US in real construction in 2026. So for the first time in years, civil engineering is revised up to 3.3%. But it's not really reflected in the market pricing. Where would you say does the re-rating happens first?
I think it probably happens in the heavy side in European IG, and that's partly because the market is still positioned for the old narrative, weak Europe, strong US. Whereas, as you've mentioned, the forward data is basically starting to flip. Now, how sustainable that flip is a moot point and is up for debate. But remember that infrastructure and aggregates volumes do tend to drive fixed cost absorption very hard in cement and heavy side materials. So if you've got civil engineering growth of 3%, that's a real positive driver of your operating performance. But of course, in Europe, IG building materials is very tight. It's well inside the index, about 10 basis points inside the index, whereas US building materials is just outside the index, so only about 1 basis point outside. So it looks a little bit more normalized. In other words, effectively, the US is trading a little bit the good news of infrastructure, data centers, pricing power, etc., whereas Europe still trades a little bit more like a structurally impaired cyclical credit. So the first compression, I would say, comes in names like CRH. In theory, it would come in names like Heidelberg Materials, but I don't particularly like the strategic position of that credit. The market, in terms of the light side, it still distrusts the likes of windows, insulation, distribution, etc., because housing and R&R remain soft. So the bifurcation in Europe probably widens further, heavy side tightens and light side sort of lags. I think the key point is that after years of depressed utilization, even a modest European volume recovery may matter more for credit than another year of pricing growth in the US. That's the sort of the optimistic upside. I would say I don't know necessarily if that's going to be the case, but I think that is what you're looking for if you're banking on a re-rating.
But on the flip side, there is Iran as the big downside risk. The longer the conflict drags on, the more downside, I guess, to the Euro construct thesis. I guess energy will hit European producers of glass, cement much harder than the US, which is much more isolated from an energy perspective. How tough does the oil or energy shock have to get before the cross-Atlantic reverses again? And which European credits are most affected?
I think the reversal only really flips back if you get both a kind of a cost shock and a demand shock. So I don't know, if you see Brent, for example, sustainably above $120 to $130 a barrel, you get another spike in European gas and power prices. I think at that point, you probably start to see European producers lose the pricing versus volume balancing act that they've been able to do very well up until now. And the first credits that would tend to hit are actually going to be anyone focusing more on glass and cement, because glass furnaces are incredibly energy intensive. You have to run the assets continuously, and it's very hard to idle any of your capacity on an economic basis. So anyone with high exposure to container or flat glass exposure is going to really feel it hitting first. In cement, the weaker names are going to be those with heavier just European earnings exposure and a smaller degree of diversification. So names like Bootsy doesn't have any debt, any bond debt, Vicat, Cementia, and then of course parts of the European footprint of names like Heidelberg and Holcim. They still have pricing power, but of course fuel, electricity, petcoke, freight, and CO2 costs, they all pretty escalate quite quickly. So overall, as far as I'm concerned, the stronger credits are going to be the more diversified, the infrastructure heavy names, like my favorite CRH, because the US infrastructure and the aggregates exposure offsets the kind of Europe situation better.
If you would be forced into a long short trade for the next 12 months, what would it be?
I think if you force me to kind of put my hand and my arm behind my back, I'd probably go long CRH and short someone like a Mohawk. Now, Mohawk is not in my current coverage, but it's a name that I follow pretty closely because of the window of coverage that I have in both the US and Europe. And of course, Mohawk has both dollar and European debt. Why would I long CRH? Because CRH wins in almost every major macro path, apart from maybe a full-blown oil shock. If Europe improves, CRH benefits from both infrastructure, aggregates, and cement pricing. At the same time, the market still largely values it as a US compounder after the repositioning to the New York Stock Exchange. So effectively, you get a free European call option on top of what is a very high-quality US Heavyside business. Mohawk, on the other hand, has the wrong type of European exposure. It's involved in flooring, renovation, discretionary spend, and of course very heavy energy intensity. So if Iran escalates and, for example, TTF gas prices spike again, then Mohawk gets squeezed operationally much more quickly than CRH. And at this stage, I'd also be cautious on James Hardie. The market tends to treat James Hardie as diversified because Australia and Europe, but actually economically, it's basically a US housing and R&R story. And the market, I don't think, appreciates that enough. Fibre cement is a good product, but it still basically depends very much on repair and remodeling confidence, housing turnover, and your utilization rate staying healthy. If volumes soften another leg lower, then your operational leverage starts to hit you very, very quickly.
What would you say does the market most underappreciate or overappreciate in building materials right now?
Interestingly, Joseph, I'd say despite the title of this podcast and despite the in-depth discussion that we've had during the course of the hour, I think the market is still underappreciating just how structurally advantaged the Heavyside is compared to the Lightside. Hopefully this podcast and other work that we're doing can start to change that perception. We've got to remember that cement, aggregates and ready mix are not just cyclical manufacturing businesses, but they are local infrastructure monopolies. They have permitting moats, they have scarce resources, they have huge replacement costs, and they have real and sustainable pricing power. So even when you get weak volume environments, you get names like CRH, Vulcan and Martin Marietta can usually defend margins really well and generate much more sustainable cash flow. And this is not really appreciated in the market as far as I'm concerned. I think the credit investors still model these names too much like the commodity end and not enough like the strategic infrastructure plays that I view them. In contrast, what I think the market overappreciates is that the idea that the stress in high yield building products is just because of the macro, because of the Fed. As we've talked about during the course of today, a lot of the stress is actually structural, coming from PE ownership or aggressive covenant packages, high fixed cost fabrication footprints, or weak pathways to refinancing. And the next phase of stress, I would say, probably looks less like classic bankruptcies and more like a wave of LMEs, drop downs, exchanges, and maturity wall engineering. In other words, for a lot of the Lightside names, the biggest risk is in capital structure design, not in whether housing starts get to 1.3 million or 1.5 million.
Andy, before we wrap, where can listeners find more of the work you and your colleagues do at CreditSights?
Thanks, Joseph. Well, obviously, the starting point tends to be our website, although we are increasingly using things like API feeds to provide our research at the location where our investors and clients make their decisions. And we also have things like apps for your iPhone. Within the website, we are increasingly trying to do things like primers, where we basically do a 101 on a particular analytical topic. The idea for us and for our clients is that these pieces of research are off the shelf, but they also have a long shelf life. So they don't contain rel-val views, and therefore they don't become stale very quickly. And just to give you an example, I'm currently am planning on turning today's podcast into a primer that really drills down on the difference between the Heavyside and the Lightside, because this is certainly a topic that I am asked at least once or twice every single week by my clients.
I didn't know about the app, but I'm a big fan of the primers. Thanks for coming on the show, Andy. I really appreciate it. And also thanks to everybody for listening to Fixed and Floating, the credit podcast. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts, and see you next time.